Welcome back to 15 Minutes of Finance. This is the tax plan where I help you save more of your money. Today's topic is rental real estate taxation, and we're going to talk about all different facets of renting real estate. We're going to talk about what has to go into rental management to qualify as an actual business and the tax implications that will have on your rental, how to rent your personal residence and how the taxation of that works, all of the above. So let's dive into it. Let's start talking about personal residences. It's going to be the briefest part of this topic, and then we'll get into all of the people who have rental units that rent out full times. So there's a couple different elements to talk about here. A couple episodes back on the tax plan, we talked about selling real estate. So I'm not going to talk about selling your personal residence. Just a reminder to the listeners, if you are selling a property that has been your primary residence for 2 of the last 5 years at least, you can sell your personal property and deduct up to $500,000 for married couples, $250,000 for single individuals on your taxes, tax-free of gain. Okay, so you buy a house for $400,000, you live there with your spouse for 3.5 years, you sell for $800,000. That entire $400,000 does not need to be reported to the IRS. It is not taxable income. It is within the $500,000 limit. Okay, so that's the big one to consider. So this topic is about renting real estate, not selling. So there's a couple considerations just to talk about in the world of personal residences. Number one, there is a tax rule that says that you can rent your personal residence up to 14 days completely tax-free. Okay, so you don't have to report that as rental income. 14 days is the maximum. Okay, so for those of you who take a vacation, I know someone who, one of my clients, they live in Montana. They took a vacation for about 30-something days. They Airbnb'd their property. I think they rented it out for like 13 days. They made some rental income. They didn't have to report that because it's under the 14-day business use or rental use limit. Okay, so that's one thing, just a fun fact to keep in mind. You can rent for very small periods. You can rent out your rental real estate or your personal residence, as a rental. The other thing to kind of consider with your personal rental is kind of what goes into it. So if you do rent out your personal residence and you don't meet this 14 days or less requirement, you are able to, you now have to report that rental income. And because of that, you're able to write off rental expenses. And so the kind of big one to consider is depreciation. Okay, so when you buy your home, you don't think about depreciation because it's not a business asset. You're not taking a deduction on your home. If you're a homeowner, probably the things that you are thinking about and that you know about come tax time are that you can deduct your mortgage interest payments and your real estate taxes as itemized deductions on Schedule A. Homeowners, that's kind of what they're focused on. Well, if you're renting out your home, there's now kind of the business element of it. And so we would take business deductions as what's referred to as a pro rata or prorated share of the days rented versus the days that are personal use. So if I have my personal home and then I leave for 3 months, okay, and I rent it out from January 1st to March 31st, okay, February has 28 days. That's 90 days that I rented out my house, right? So depreciation, utilities, insurance, HOA fees, cleaning, maintenance, all of those type of costs, I would take 90 3/65ths, and that's the amount that I could deduct to offset rental income. Okay, so you take the amount of days rented divided by the amount of days in the year. That's your pro rata percentage of what percentage of the days were rental. So now all of those expenses, you can write off that proportionate share of as legitimate business expenses because that's the portion of those expenses that were used during business rental times, even though it is your personal house. So when we factor in depreciation, it's the same thing. We would now you would have your CPA or whatever, the person that does your taxes, record your house as an asset. You would depreciate for residential property. That's 27.5 years life. So you would take 1/27.5 of the value of your home that you paid for it each year as a depreciation percentage, and then you would multiply that number by 90 over 365, and you would take depreciation on it. Okay, so that's one thing that you might not consider if you have a partial rental of your home for some portion of the year. You need to factor in depreciation. Depreciation does not include land. So that's a very important distinction. I don't think I've worked with anybody who has known that, to be completely frank. So people who have, and it's the same calculation, by the way, for a home office, and we've had an episode on that too. So it's the same depreciation kind of considerations, where you have to take the value of your home, but you have to deduct the cost of your land. Okay, so land does not depreciate. Okay, only the building does. So hopefully, when you bought the house, the closing statements had an assessment that divided the cost by the value of land versus the value of what's usually referred to as improvements on the land. That's what your home would be referred to as. The other option that you can do if you can't find a definitive fair market value is you can use the most recent county property tax assessment of the land, and then you would take their percentage of what's land and what's improvements and use the cost that you paid, multiply by those percentages to get the cost that you paid allocated to land versus depreciable buildings and improvements, which is your actual home that you can deduct on your taxes. Okay, so to wrap all that up, I feel like I was not very succinct on that. So you have to have a value of your land, and you need to exclude that from the depreciable value of your house that you paid. You can't just take the total cost you paid for your home on the closing statements and then take the depreciation percentage of that. So you exclude the land. That gives you the depreciable basis in your property. Then you multiply by the applicable rate, which for most people, you live in residential property. That's 27.5 years. And then you take that number, you multiply by your business use percentage. In the example we were just talking about, that would be 90 over 365. Maybe you only rented out your home for a month and it's 30 or 31 divided by 365. Whatever the business use percentage is, that's the amount of depreciation that you can take. So there's a couple considerations just to start that you can consider for your personal residence. Let's talk about really the point of the episode, and that's people who have rental units, people who rent real estate. What are the considerations and what are things that can help you maximize your tax deductions? So let's get into it. Rental real estate is considered passive income, right? So you have a property, it's rented out, you receive rental income, and that's passive income to you. On your tax return, your rental income and expenses will be reported on Schedule E, like elephant. Your business will be on Schedule C. Your itemized deductions will be on Schedule A. Capital gains are on Schedule D. So there's these different schedules if required on your tax return. So rental property is on Schedule E, okay? Schedule E. So you'll record that income in box 1 of Schedule E. There's a list of all the expenses you can take, including, again, depreciation. In this case, assuming this is a rental that rents out all year, you take the full value of the property. There's no business use percentage. You just take the full value because it's 100% rented, and then you multiply that by the 27.5. Okay, so you have your depreciation, you have HOA fees, you might have management fees, you might have utilities. Maybe you pay for water and electric and Wi-Fi. Maybe that's part of the cost of rent, and you get to deduct those as costs to maintain the property. You might pay cleaners, you might, whatever it is, groundskeeping, all those expenses that go in, and then you have a net income or loss. So the big thing to consider with the fact that it's a passive activity is that passive rental losses, or just passive losses in general, losses that are not generated by active business activities, are limited to only being able to offset passive gains. So for a lot of people, if you buy a rental property and then you do improvements to it, and then you have a bunch of costs to a consultant to do whatever, and you pay a management company for all the listings and to help you vet tenants, right? And then you have all of these costs. You could spend $30,000 to $40,000 in the first year. You might not get a tenant until October. You could have a $35,000 loss, right, in the first year. You're not able to deduct that $35,000 because it's a passive loss. Now, if you had a bunch of capital gains or interest income or maybe rental income from other properties, you could use the passive loss to offset that other passive income. But you can't just reduce your W-2 income by the full amount of your passive loss from rental income and rental activities and gain a massive refund that way. Okay, so that's a super important consideration. Okay, especially if you're losing money and you want to write off those losses. But there's also a big factor, even if you're profitable, with the fact that rental income is passive. And that's the, I believe it was in the Tax Cuts and Jobs Act. So that's 2017. That's the Trump TCJA. Tax Cuts and Jobs Act. That's the big one that made a ton of changes. It doubled the standard deduction. It limited a lot of itemized deductions. It changed tax rates. There were lots of changes with that law, one of the bigger tax laws in recent history. One of the things that tax law did is it instituted what's referred to as a Section 199A deduction. That is a deduction on pass-through income from business activities. That would be LLC income for being an owner in an LLC, owner in an S Corp, a sole proprietor. Those all qualify. Rental income does not, because it is not considered an active business activity. It's passive income. So that's a big deduction. That Section 199A deduction, which is also kind of colloquially referred to as the QBI, Qualified Business Income Deduction. So the QBI deduction, a lot easier to say that than 199A. So we'll say QBI deduction. It's up to 20% of the income. So if I have an S Corp and I have $100,000 in business income, I get a QBI deduction of $20,000. So it offsets 20% of my income. That's huge. It was a massive, massive tax help for small businesses in this legislation. So that's been a big thing for the last 6-7 years. You can't do that with rental. So there is a big consideration and a big incentive most of the time to consider your business income as an actual, or your rental income as actual business activity, that it's an active business. And the IRS does not limit you to an amount of property to consider managing and maintaining rental units as a qualified business. That would then make the income active. It would allow you to take the QBI deduction. There might be other things that you can now take, like a home office or some travel costs, because it's a legitimate business now, mileage to visit all of your different properties. Okay, so there's a lot of considerations here that you may gain access to if you have a legitimate business. And you can have a legitimate business even if you only have one unit, if you are involved enough and it's that active of a management to do it. So here is how the IRS allows you to qualify for being an active business owner by having rental real estate. So there's 3 things specifically that it talks about. You have to have separate books and records maintained for each rental activity, or you can combine them if you group them all under one business or enterprise or whatever. You have to have 250 hours or more of rental services per year. And beginning with tax year 2019, so obviously that applies to us, the taxpayer maintains contemporaneous records, including time reports or similar documents regarding hours of services performed, descriptions of services, date of services, who performed the services. So you can't just say, yep, it's active, I did 250 hours. If you do the math, 250 hours is a lot. That's why most rental income is passive, okay? So not a lot of people spend 250 hours over the course of a year managing one rental property. They might if they have 5 of them and that really is their business, then they probably easily qualify. So it's very important to understand, do you meet that threshold and what constitutes rental services? Okay, so first I'm going to talk about the things that don't qualify, because then pretty much everything else does. So the things that the IRS specifically excludes to get what's referred to as the safe harbor that says, yes, if you meet these requirements, you for sure qualify as this is a legitimate business activity. Financial or investment activity, so arranging financing, getting a loan for the property, that's not part of the rental services, okay? That's the acquisition phase. Procuring property, so again, finding the actual property itself before you're renting, not part of it. Studying and reviewing financial statements or reports, so going over your balance sheet, going over income doesn't count. Planning, managing, or constructing long-term capital improvements, so improvements to the property, adding a room, that doesn't count, okay? So you can see, and then one more, hours spent traveling to and from the real estate. Most people would consider that part of it, so that's very important to understand. The IRS does not consider driving to and from the property hours. You can kind of see how people would just, well, if I can just go there 3 times a day or 3 times a week, and it's a 45-minute drive, that's an hour and a half, 4.5 hours, I'm almost there. I'm more than halfway there. You can't just do a bunch of driving. So that does not count as part of your hours. Okay, so you can see that there's really kind of 2 main categories here. Anything related to acquisition of property, expansion of property, getting loans to buy property, that's not part of it. They are only including rental services as things actively involved in the management and rental of the properties that you actually own. Okay, that's what the IRS considers rental services performed. We'll real quick now go through specifically what they outline, but they're basically everything else that is actually involved in the rental income, the rental services. So that's advertising to rent or lease the real estate, negotiating and executing leases with tenants, verifying information contained in prospective tenant applications, collection of rent, daily operation, maintenance and repair of the property, management of the real estate, purchase of materials, supervision of employees and independent contractors involved in the property. Those are the things that they outline. So let's now kind of recap real quick, okay? So all of those rental services, the management, the reviewing applications, getting new tenants in, fixing the property, maintaining the property, all of that stuff, okay? If those add up to over 250 hours in a year, that rental management counts as a legitimate business activity, okay? Now when that happens, you get potentially the QBI deduction to deduct 20% of that income. It's now considered active income and losses. So if you're losing money, that allows you to now use these losses to offset your main income, W-2 or active business activities, however you earn your income. And if you have other kind of deductions for business operations like a home office or mileage, you can't count those miles driven in your time to qualify as active rental, but you can deduct them. If you have multiple rental units driving to and from those different units, you can deduct those miles as legitimate business miles and get the 65.5 cents per mile IRS deduction, the standard mileage rate. Okay, so there's a lot of things that you gain access to by meeting this business threshold, okay? So very, very, very important consideration. Could be an important enough consideration that you might have to sit down and say, if I review last year, realistically, I probably spent 160 hours managing my 3 rentals, okay? Maybe you pay a management company less and do more yourself. If I can work 90 more hours, I can deduct 20% of that income on my taxes. I can write that off. Then I get a home office. Then I get miles. I get all of these things. It might be worth it to spend a little bit more time yourself if you are in range where you can legitimately get to meet this requirement that you are legitimately running a rental business and it's not just 1 or 2 properties that somebody else manages that you just get passive income for. So tax-wise, very important consideration. The last thing we'll talk about, and I won't go super in depth because we will have episodes about this, and I think I've already talked about this a little bit. Because you're now a legitimate business, okay, there's a major consideration to consider now as well, which is the structure of your business. So if most people have each property owned by a separate LLC, it just makes sure that if there's some massive flood in your property, okay, each LLC, the only assets in that property that could potentially be, as collateral for damages to that flood, is the value of that specific home. But if they're all owned by one LLC and there's some huge, one of your house explodes, okay, to use an extreme example, and there's millions of dollars in damage to the surrounding community, okay, your total value of assets potentially liable to cover those damages is everything the LLC owns, which is all 10 properties, okay? Where if each LLC owns its own property, you limit your liabilities. That's how most people do it. What you can do now, if you meet the requirement to be a legitimate business operation, is you can have all of those LLCs owned by a parent company that can be an S corporation. And without going into a bunch of details, the main consideration here is that with an S corporation, income to the business is not considered self-employment income. It's just considered business income. So if you're running a business as a sole proprietor, as an LLC, you're paying the 15.3% self-employment tax rate on all of that income. Well, as an S corporation, that's now just considered business income to the S corporation owner, which is you. It still qualifies for the QBI deduction. S corporations are in the list of businesses that can qualify for the QBI deduction. So you can still get that 20% deduction. And now you're also saving that 15.3% because you're not paying self-employment tax on the rental income of your business. So that's the last kind of major consideration that I'll leave you with is if you meet the requirements to create a legitimate business for your rental units, you meet the 250 hours, okay? In addition to the QBI deduction, in addition to potentially being able to write off miles, be able to write off a home office, you might also be able to run this as an S corporation and then save on self-employment taxation. And that could be another 15.3% that you can save on your income by not paying that self-employment tax rate. Okay, so a lot of considerations here. There's things to know about rental units when you take depreciation. First of all, make sure you're taking depreciation. Make sure it includes everything you spent for your house, but make sure it does not include the value of the land. You can't depreciate land. And then the big consideration here that we've been talking about, make sure you understand if your rental activity can qualify to be a legitimate trade or business. The IRS refers to that as a Section 162. That's the part of the tax code that refers to trades and businesses. So you want to make sure, if it's possible, that your rental income and your rental activities qualify as a Section 162 business activity. And now you get QBI deductions, home offices, all of those things. So major things to think about that can potentially save you. I mean, do the math here. You get 20% on the QBI, you save 15.3% on self-employment taxes, you might gain access to new deductions by being a business. We're talking, could be 35% income tax saved, plus extra deductions, writing off more of the income. These could be tens of thousands of dollars that could potentially be saved if you have a lot of rental activities or you make a lot of money on your rental. So huge consideration, especially for people who have owned property for a very long time and you've already fully depreciated the value of your home. It's been 27 and a half years. So you don't even get depreciation anymore. So there's very little write-offs now, and you have a ton of income from this old rental that you inherited 30 years ago when your parents passed away, and now you've been running this rental for 30 years. It's gone up 5 times in value. You're getting $4,000 a month in rent and you have almost no expenses. Well, the S corporation thing can make a lot of sense. Managing it yourself, making a legitimate trade or business can make a lot of sense, and you can really start to save a lot of money depending on the situation that you're in as a rental unit owner. Thank you so much for listening to another episode of The Tax Plan. It's always great to have you. As always, please leave any comments, send us questions that you would like to hear answered in future episodes or a topic you would like to hear covered. As always, invest early, invest often, and we'll see you next time.